Good morning, everyone. My name is Carl Grund, and we're here today for the third installment of Coffee with Carl. This morning, I had the pleasure of having David Leibowitz. He's an executive director and global market strategist with J.P. Morgan. How are you doing today, David?
I'm good, Carl. How are you?
Doing wonderful. So today, I'm going to spend some time just going through the market today with David and talking about where we are and certainly where we're going. Obviously, it's been a very challenging time, and every day seems to be provide for a new eventful day, for that matter. David, if you wouldn't mind, I guess give us a little highlight about where you guys see the state of the economy and the market. There seems to be quite a real disconnect, and it's continued between the stock market and Main Street. And then I even saw this morning with CNBC going over their most recent poll, and there's a big connect even between economists and Wall Street. Can you give us some highlights about how you write that and where you see everything going?
Yeah, absolutely. And thanks again for having me. So, what I would say here is that one of the questions that we've been getting quite often from our clients is really what's going on in the stock market, given that the outlook for the economy doesn't really look all that great. And I think that the first thing I would say is it's important to remember that markets are forward-looking, right? Markets discount information. And so the question really becomes, what is the market looking forward to, and how does that align or fail to align with our expectations around the direction of travel for the economy? Up until this point, I think the market has really been driven by a couple of things here. Until the past few weeks, it was being driven by a deceleration in the rate of case growth. It was being driven by the unprecedented policy response that we've seen on both the monetary and the fiscal side. And it's being driven by an expectation that we'll see a V-shaped recovery in corporate profits over the course of the next 18 months. And, again, I acknowledge that until quite recently, case growth had been slowing. And when you look at what's going on today, yes, case growth has accelerated over the past couple of weeks, but the mortality rate has remained much lower, and markets seem to have shifted their focus to that variable rather than the number of cases themselves. Again, the policy response is somewhat undeniable. I think what both the Fed and the federal government have done here, as I mentioned earlier, is frankly unprecedented. But this lingering issue of a V-shaped recovery in corporate profits does feel like a little bit of a stretch. And when we think about the ability for earnings to get back to an all-time high by the end of 2021, we can make our models churn out those numbers, but we're not necessarily comfortable with the assumptions that we're being forced to make. So, when we look ahead over the next 18, 24 months, we see an economy which remains challenged. We see an unemployment rate which is at its highest level since the 1940s, with the exception of the prior 2 months. And we think that the road to recovery is going to be a bit more challenging than certainly what the equity market has priced in. So that does make us a little bit cautious as we embark on the end of the summer and the beginning of the fall, particularly with the election sitting on the horizon in November. And I think if nothing else, what we're in for over the next couple of months is a period of elevated volatility as the equity market and as investors really figure out what the direction of travel for the economy more broadly is going to look like. I don't want to call it a head fake, but the acceleration that we've seen over the past couple of months simply from restarting the economy, I think has been extrapolated over the course of the next year and a half. And from our vantage point, things are going to be a little bit more challenging than that. So I wouldn't be surprised to see the markets chop around here in the short to medium term.
Yeah, you talked a little bit right there about some of the potential headwinds. What in particular out of those would you say would be the most concerning to you guys as far as an upcoming headwind? Would it be the election, or are we more or is it the potential for a second wave? And I know we're starting to see some stuff coming up in Asia again and in Spain. So what would, I guess, is there one that you guys would pinpoint as the biggest concern for you?
Yeah, absolutely. I think that the whole concept of a second wave is somewhat inevitable. You did see parts of Europe and Asia do a quote unquote better job controlling the virus over the past couple of months than perhaps is the case in the U.S., but now they're seeing case growth rise. And so I think that until we have a medical solution, the unfortunate reality is that this virus in and of itself is quite difficult to contain. You know, when I think about the biggest risk going forward, obviously the election is front of mind for a lot of individuals, and we can certainly unpack our thoughts there if it's of interest in the next little bit. But to me, the biggest risk really has to do with the labor market. And I mentioned earlier that the unemployment rate spiked to a level of 14.7% in April of this year. It then unexpectedly fell over the following 2 months to a level of 11.1% in June. Again, that's still the highest level for the unemployment rate since the 1940s, barring the prior 2 months. And the risk is that the unemployment rate fails to decline here over the next 6 to 9 months, you know, into the end of 2020 and the beginning of 2021, and we kind of see things stagnate at their current levels. And the reason that we think that's the biggest risk is because, look, if the unemployment rate continues to decline here and you know, we get to the end of 2020 and we're down at, call it 10%, what that says to me is that the economy is in the process of recovering. The excess supply in labor markets is gradually being reabsorbed, and the recovery should continue over the course of 2021. You know, again, the risk here is that the unemployment rate fails to continue its decline, kind of stops out at its current levels, and what that would signal to us is that there has been more structural damage done to the underlying economy than a lot of people think, and certainly, you know, to the prior question, certainly more than what the equity market is currently pricing in, and that would suggest that the road to recovery is going to be relatively challenging and likely longer and more difficult than what a lot of people are expecting right now.
Yeah, are you guys ever concerned with, or when we look at some of the, you mentioned unemployment rates, so it's certainly improved, but does it concern you that maybe some companies are just hiring just so they can get the PPP money? Does that factor into the equation at all?
You know, it does. We do acknowledge that may be the case. I mean, the reality of the situation is they're doing the best job they can to figure out, you know, are companies using these PPP loans the way that they're supposed to be used. You know, the bigger concern from where we sit with respect to the labor market, it really has to do with the way that workers are being categorized. And, you know, a lot of people believe if you've gotten laid off, there are a lot of people that believe that they're temporarily laid off, right? And when the economy comes back online, they're going to end up getting their job back in hand. And I think that's a big assumption to make. You know, there was a really interesting paper out of the University of Chicago, maybe 6 weeks ago or so, which highlighted that of the total number of people who believe they are temporarily unemployed, nearly half of them will end up being permanently unemployed. And, you know, if something like that occurs, again, that kind of factors into our focus on the labor market, because that's a much more difficult situation to recover from than one where people get their jobs back as the economy gradually restarts and begins growing once again. And so, you know, I think that the bigger issue from where we sit is probably one of miscategorization and the risk that these temporary layoffs end up being permanent. But also, you know, there could very well be some hot air in the proverbial balloon with companies taking their PPP loans, keeping people on their payroll, and then once those loans expire, letting them go. That's definitely another risk as well.
And then when we talk about potential risks to the market, and obviously the opportunity for a vaccine, you know, hopefully by the end of the year, have you guys factored in, you know, the thought process that maybe, I know they've run some studies where 20 or 30 or some 40% of people wouldn't even take the vaccine immediately. How does that factor into your guys' planning with the S&P and your performance, et cetera, if a lot of people simply just don't take the vaccine right away and the virus continues to flourish?
Yeah, no, I mean, I think that's a risk. I think a lot of people look at a vaccine as being a binary event, but it's also important to recognize that most vaccines are developed over, you know, 5, 10, 15-year periods, not 5, 10, or 15-month periods. And so there will undoubtedly be some skepticism around the efficacy and the safety of a vaccine once it is produced. And I actually think that zooming out, you know, this is a really important issue because it all comes back down to the issue of human psychology. And it's not only will people take the vaccine, it's, you know, when will people feel comfortable going and sitting at a restaurant inside again? When will people feel comfortable getting on an airplane to go on vacation? When will people feel comfortable, you know, in New York City getting back on the subway, where we're seeing things begin to come back online, but we will be dealing with these psychological hurdles for the foreseeable future. And I think that that's one of the risks that really doesn't get enough airtime these days, which is just because you can do something doesn't necessarily mean you will do something. And we think it's all about controlling the virus itself. It's also about undoing the past 4 months of social distancing and self-quarantining and getting people comfortable with some sort of return to normalcy and kind of picking up where they left off earlier this year.
That makes sense. And then for you guys, I've seen a variety of different price targets on the S&P in particular, anywhere from, all of a month ago, we were talking, most investment banks, I think, were like 2950 on average to 3,000. Now we're starting to see that number push up. What is your guys' base case for the S&P at the end of the year, and then potentially a bear and a bull case on the S&P?
Yeah, absolutely. So I think that, at the end of the day, the way I think about price targets is it's a great way to always be wrong. Very rarely do people hit the nail on the head with respect to where the equity market ends the year. So, when I look at the targets and I look at the same information that you do, 3,000 seems fair for an estimate of where we are at the end of the year. A bull case would be getting that vaccine much sooner than expected and seeing things really take off. And I do believe that, given we've seen the majority of the market's movements this year driven by a handful of growth stocks, that would see broader participation from some of the epicenter stocks that have really been crushed by everything that's gone on over the course of the past couple of months. The bear case would just be continued waves of infection and furthermore, a bit of a failure to launch with respect to continued policy support. We're watching Congress debate another round of fiscal stimulus right now. From my vantage point, they need to do something. They can't just let these unemployment benefits expire at the end of July, because at the end of the day, there aren't jobs for most Americans to go back to, given where the economy is right now. And so, what would make me really pessimistic on the outlook is if you saw infighting in Washington begin to undermine that fiscal support. I don't think that the Fed is gonna remove their accommodation anytime soon. But obviously, if the Fed were to suggest that their stimulative response was perhaps nearing its end, I think that would add insult to injury as well. And so, it really comes down to a vaccine driving the bull case and an inadequate policy response driving the bear case. Neither of those seem terribly likely in our view before year end, and that's why we're continuing to expect that the market's just going to bounce around here until we have a little bit more clarity on the direction of travel, not just for the remainder of 2020, but into 2021.
Yeah, and I think, I guess along those lines, if we talk a little bit about just presidential regimes, how do you guys see things playing out under a Biden presidency or under Trump? I know when we look at options movement, I think they're predicting, an 8 to 10% move on the election. Do you guys see it being that dramatic, or do you see it being something that would be just a immediate move and then, slowly work its way back to normalcy under either presidency?
I think that the big risk here, and when we spend a lot of time thinking about, politics and what that means for policy, and frankly, from a policy perspective, I think it's kind of a wash, regardless of who takes the White House. Both Biden and Trump are going to be tough on China. Biden is probably going to raise taxes. Trump would leave taxes where they are. Biden, you'd see more regulation. Trump, you'd see less regulation. They also both agree on the need for an infrastructure bill, so that's kind of a silver lining to either candidate's getting elected at the end of the day. To me, the biggest risk to the equity market really lies in the issue of an increase in the corporate tax rate. And look, I totally understand that given the build and the debt and the deficit that we've seen over the past couple of months, we're going to have to raise taxes at some point down the road. And it's arguably better to do it sooner rather than later and try to get ahead of any additional debt builds. But, we don't want to do it so soon that we knock the economy off its feet just as things are beginning to come back online. And so, to me, in kind of the medium term, what could really upend the equity market would be an increase in the corporate tax rate at some point in early 2021, because I just don't think that the economy and corporations are going to be in a position to handle that. And it would further undermine that thesis around the potential for a V-shaped recovery in corporate profits that the equity market is seemingly continuing to price in here. So, to me, that's really the risk. I acknowledge the fact that higher taxes are more broadly a question of when rather than if, but I think the timing here is really important. And to me, that's the biggest risk that politics pose to equity markets here in the short to medium term.
What would you say? I guess I have a number of clients that are trying to figure out what to do with cash, right? And because they're a little bit, would you say we're probably at the more high end of this bouncing around period? And then if so, where do you think might be the lower bound? If they're looking for a potential better entry point.
Yeah, absolutely. I do think that in general, markets are closer to the higher end of the range. Looking at the S&P today, right around 3,200, 3,250. That's not all that far off from the all-time high, and so I would characterize that as being at the upper end of the range. In terms of how far or how much lower we could go, to my mind, bouncing around between kind of 3,250 and 2,750 is a reasonable expectation going forward. I think that there is an element of this rebound in equity markets that has clearly been driven by the policy response. And one of the things that we acknowledge is that, we need to thread the needle here in terms of passing the baton from policymakers to actual economic agents, because the stock market doesn't really care where the cash flow comes from. They just want to know that there's going to be cash flow, right? So if that's coming from the government, that's okay. If it's coming from, fundamentals and the economy itself, that's okay too. But what the market is going to get really uncomfortable about is if it looks like or feels like those policy supports are being removed prematurely. And I think, just given what we're seeing today, right now, with respect to, the Democrats and the Republicans and the inability to come up with a next round of COVID relief, there are going to be periods where it starts to feel really uncomfortable over the next couple of months. I think that the election will kind of compound that discomfort that clients may feel. And so we do foresee a fairly wide range on the S&P, but what we do not see is a retest of those March 23rd lows. I think in general, investors have a lot more information around the virus itself, the way that the economy responds, what economic agents are doing to, keep businesses running during this period of massive uncertainty. And so I don't think we need to go back to where we were, but I certainly could see things come off the boil relative to where they stand today.
With regards to your guys' portfolios, how are you guys hedging? I know traditionally people will look to fixed income, but when you're generating yields of only 1, 2, 3, 4% without going into lower debt quality, how are you guys planning for that? Are you keeping some cash on the sidelines? You're just waiting for the better opportunity, or employing some hedging strategies? What are you guys doing in that space?
Yep. So a couple of thoughts there, and we wrote a paper last year as part of our long-term capital market assumptions, which was really about rethinking safe haven assets. And the first thing I would say is that there really isn't a better diversifier to equities than high-quality fixed income, than treasuries. And so we still are comfortable owning treasuries in our portfolios because we do believe that at the end of the day, they will zig when the equity market zags. Now, the complicating factor, as you pointed out, is they're not paying you anything. Right, and in inflation-adjusted terms, you're actually losing money. And so ways that we've gone about mitigating some of the risk that comes from our equity portfolio is using, option-based strategies on the equity side, broadening out our definition of protection and embracing, various types of currency overlays, and even investing in things like gold, which, historically we haven't been big fans of, but given that the opportunity cost of owning gold is so much lower given the level of interest rates, we do acknowledge that, one, it's a nice diversifier, and two, if we do end up seeing inflation at some point down the road, that's going to be a potential hedge against that outcome as well. So we've definitely broadened out our definition of how we think about diversifying portfolios, but importantly, we're not completely running away from high quality fixed income. Rather, we're just trying to figure out how to complement that. And that means holding a little bit more cash, holding some foreign currencies, holding things like gold, and using those to, alongside things like treasuries, protect against those downward moves in the equity market that are inevitable. I think that despite the speed at which things have moved, and despite the fact that we do expect policy to remain supportive, we are quite cognizant of the downside given the speed and the pace of this recovery in markets over the past couple of months.
How much farther do you think gold can go? I mean, we've had quite a already extraordinary run in the gold space as well.
That's the question, because the only thing that, the only way that you can figure out what gold is worth is to ask what somebody will pay you for it. There are no cash flows to discount. It's really an asset where pricing is driven by sentiment and the broader outlook. And so, do I think gold is going to double from here? Well, no, not necessarily. That would surprise me quite a bit. But I'm not sure that it's really fair to call upside being capped at a certain level, because there's really no technical or quantitative way to come up with what fair value would be for that type of asset. And so, we acknowledge the run that it's had, but we continue to see a lot of client interest in not only gold, but commodities more broadly. And to my mind, that means that there's probably still some upside, even from current levels.
That's a very good point. Why don't we take a shift to the equity markets? What areas of the equity markets do you guys currently find most attractive?
Yep. So, we still like growth stocks for the longer term. We believe that owning things like technology is really much more of a secular trade. Certainly acknowledge the issue of market concentration, and perhaps these names have run too far too fast. But, over the next 10 to 15 years, technology and healthcare are really two sectors that we want to have sufficient exposure to in portfolios, because we do think that there are long-term tailwinds supporting their outperformance. From a shorter-term perspective, a lot of the equity market has been left behind over the course of the past couple of months. And when we look at the world that we're in today and we see the dollar weakening, we see coordination on the policy front in places like Europe, we see foreign economies in general having done a better job controlling the virus than is the case in the U.S., we are inclined to take a little bit more of a value tilt in our portfolios and embrace things like industrials and financials, where, we've liked the banks for a while, but we're much more comfortable owning those sectors like industrials and like materials that have more broadly based exposure to the global economy. And, when we think about growth versus value, leaning into value also means that we're leaning into international markets a bit more than we had been over the course of the past couple of months. We do think that because those markets are more value oriented, they do have the potential to outperform the U.S. here in the medium term. But again, don't want to completely run away from that growth exposure that you get from things like U.S. equities, really trying to remain balanced here going forward, given the uncertainty that continues to persist and given our expectation for volatility through year end, where we're essentially trying to build portfolios that will protect on the downside, but participate on the upside and not create such a bumpy ride for our clients that they end up jumping ship at precisely the wrong time. We want to make sure that clients get to the other side of this experience so that they can participate in the upside that things like equities have to offer during longer periods of time.
On the international trade side, are you guys more looking towards developed or more the emerging markets options?
Yeah, so our preference would be for emerging markets over places like Europe and Japan. I do think, again, the clouds are breaking over Europe. To me, that's more of a trade and less of an investment. Where we really like the long-term structural story is in the emerging markets, where we see younger populations that are growing more quickly, higher rates of productivity growth, and rising wealth. And so, when a lot of people think about emerging markets, they think about the BRICS, right? They think about Brazil, Russia, India, and China, all of which have large exposure to things like manufacturing and commodities. And when we think about playing this story of an emerging middle class and really trying to capitalize on some of the trends in the emerging world, we're much more interested in owning services businesses, particularly services businesses in Southeast Asia, because when we take a step back and think about it, when people have more money in their pocket, they want to send their kids to a better school. They want to open a bank account. They want to take better care of themselves from a healthcare perspective. And that story really resonates with us far more than trying to play commodities or manufacturing, given our expectation for, manufacturing margins to continue to contract and the unlikelihood of another commodity super cycle given the direction of travel for the Chinese economy.
I guess with regards to China, I know there's been a massive run up in the internet space. Do you guys still foresee that continuing, or would that be an area that you might be a little bit concerned that it could be topping off soon?
You know, the Chinese equity market is still very much retail driven. And so I do think that you see, irrational exuberance rear its ugly head a bit more often than what we see in places like the US or Europe. We would be a little bit skeptical of some of those internet names. We'd definitely be more comfortable owning things like healthcare, education, financials, so on and so forth, where, you're not as beholden to kind of a story or an idea. You're much more beholden to the underlying fundamentals of the economy and that idea of rising wealth over time. And so to us, that would be the preferred way of playing it. I'm not saying that there aren't good stocks in the technology and the internet sector that we don't want to own, but we definitely would be spreading our chips around and trying to take a more diversified approach that is more broadly encompassing of the trends that we see playing out in China over the course of the next 5 to 10 years.
And then you mentioned a little bit about value before. I know we've had, much more recently, we've seen Buffett start to make some purchases specifically in the financial space and as well as energy. How do you guys look at energy? I know that's been an interesting place because a lot of people think there's a lot of shadow companies out there that won't really be around. How do you guys view that? And do you guys find it interesting that you're starting to see some of those investments going back into that space as well?
The energy thing is interesting because we were big fans of energy coming into all of this, just given the yield that sector is spitting off here at the current juncture. We then kind of took our chips off the table when we saw what was going on with OPEC and Russia, and obviously less driving due to COVID. But we are beginning to look more closely at the energy sector here because of a couple of things. One, we continue to like the yield that sector is generating, and it looks particularly attractive when the 10-year Treasury is only providing you with 60 or 70 basis points in yield. The other thing is that I think the energy sector in general is positioned for a period of relatively significant consolidation. You've begun to see more M&A transactions. You've begun to see bigger players going in, and rather than developing, say, a shale business or a fracking business on their own, they go out and buy one who have fallen on tough times, given everything that's transpired over the course of the past couple of months. And so, I think you need to be ready to deal with volatility. I think that the price of the underlying could certainly bounce around quite a bit, given that we do think the world is still awash in oil, and given some of the uncertainty around, when the economy fully comes back online and what exactly that looks like. But, as a long-term investment, it's definitely looking more interesting from where we sit, not only because of the yield, not only because of the valuation, but because energy is something that we need. And I do believe that over time, these businesses are going to evolve and move away from traditional oil and gas, begin to embrace things like renewables, and these energy companies are going to be much more holistic than perhaps they are here at the present.
Well, you just mentioned something on the renewable side. How are you guys looking at ESG investing? It's been a big theme. There's been a constant flow of new money going into the space. How do you guys look at that space as a whole, and how do you look at that trend continuing? And do you think it's really going to start to have a big effect on how companies are run and frankly, how portfolios are managed as well?
I do think that ESG is going to see its role increase going forward, and we take a little bit of guidance from what has been going on in Europe over the past couple of years, where ESG has had significantly more momentum than is necessarily the case here in the U.S. To me, I think it's from a social standpoint, it's the right approach to take, right? We want to make sure that we're taking care of our people and our planet and so on and so forth. But to me, it's not really about E, S, and G. It's really about the G. And I think if you get the governance piece of it right, the E and the S really fall into place. One of the things that we always look at when we're evaluating the potential investment opportunities is, what are the people who run these businesses like? Would you want to sit next to them on a flight from New York to LA. Well, I'm not sure anybody wants to get on a flight from New York to LA right now, but in more normal times, would you want to have a cocktail with them? Would you be okay sitting next to them on the plane? And do they really seem to have the business's best interest in mind, or are they just trying to turn a profit? And I think that if you evaluate managements and you look at governance quite critically, again, then the pieces fall into place where more likely than not, they're going to be environmentally responsible. They're going to be socially responsible. And those are the companies that we're particularly focused on as we think about continuing to integrate ESG within the context of our portfolios more broadly.
That's, it's been very interesting in the space as a whole. And it seems, at least when you look at the returns, some of the companies that have followed that trend have actually performed very well. But it looks like we've come up on our time. So as a quick summary, so you like the areas just in the U.S. markets from a long-term perspective of growth and tech, with more immediate focus, potentially tilting towards value, as well as long-term great opportunity in the emerging market space. Is that correct?
Yep, I think that's a pretty accurate summation.
All right, perfect. Well, David, I definitely appreciate your time and wealth of knowledge, and just want to go ahead and thank you again for this morning.
Absolutely. Thanks for having me.
All right. Thank you so much. Have a wonderful morning, everybody.